In the world of insurance, tailoring your coverage to your lifestyle and your employment status is crucial. Whether you are a salaried or self-employed, the dynamics of life insurance differs. The key lies in understanding these nuances. When was the last time you reviewed your insurance portfolio? And how do different stages of life impact the composition of the ideal portfolio mix? As life progresses through various stages, so should your insurance portfolio. Join us in exploring the ideal insurance mix for every chapter of your life, safeguarding your future with precision and foresight.
Asset allocation in the 50s. When a person reaches the age of 50, we can safely say that he has reached the midpoint of his life. Importantly, quite a few of his life goals may have been completed by then. He would have a house that is fully paid for. Children's education, in many cases, would have completed. A lot of things that he wanted to do, like buy a car, see the world, a lot of things would have been accomplished, though he would still want to do more. Financially, he should have reached a state where he is almost financially free, if not actually financially free. Only a few things would be left to be accomplished in that decade if a person is a diligent saver and a sensible investor. But the need for asset allocation is not going away anytime soon. Why do I say that? I say this because the potential to stretch and do more opens up for him at that phase of his life. Earlier, a lot of needs would have taken away a lot of his income. So the disposable income may have had limitations. Also, in the 50s, the income also tends to expand for quite a few people. It's another matter that in many industries, income tops out in the 50s. The mid 50s, people hit their peak income and often become unemployable. So the 50s is a very critical phase in more ways than one. And in such a phase, can you really do without asset allocation, or what can asset allocation do for you in the 50s? Let's ask Subra. Subra, over to you.
50s is the time, like you said, it's a time when people have to take stock of what they are doing. When I say 50, I mean the man is 50 and the woman could be 47, 48, whatever her age is. But it is the man's age with which we are going to plan the future. So maybe she has got another 10 years to go and he has got another 7, 8 years to go. 58 is a normal retirement age in India, assuming he is an employee, etc., etc. So it is a time when he has to find with what asset class he is comfortable. Some people are comfortable with real estate, some people are comfortable with equity, some people are comfortable with debt. And also you have to now plan for your 60s and beyond, or 55 and beyond, when your income stops completely. This is the first time in your life when you are not going to be very happy with the downturn in the market. Till now, a market going down was a great opportunity because you got more units with your SIP or you bought more shares when the market was down. Now is a time when you don't want the market to go down because you may just be reaching the stage when you are only going to withdraw. Maybe that will happen at 55, 56. So assuming it happens at 58, you have got another 8 years of investing, which is a time when you can just max out all your investment because you are earning well, like you finished all your goals, your expenses are over, maybe your kids have gone away, maybe your kids are still there, but they are self-sufficient, you don't need to fund anymore. This is the time when you could go whole hog into equity. Now this sounds odd, but if you have not done enough of equity so far, it's a great time to be putting money in equity because your withdrawal is at least 12-13 years away. Assuming you start withdrawing at 62, because even assuming you retire at 58, you will have your gratuity, PF, everything coming in, which you can extend for next 3-4 years and then start doing a systematic withdrawal from your portfolio. But this is also the time when you should be thinking of what is the income that you want during your retirement and how much of that income you want is very solid. Because the more solid that you want as an income, you have very inefficient products like annuity. Annuity is extremely inefficient, but it is one asset which can never go to zero. Till you are alive, it will pay you. At some stage, maybe you're 85, 90, you want simplicity of portfolio. At 20, you don't want that, but at 80, you want simplicity of portfolio to understand on the 7th of the month, I'll get my annuity, on the 10th of the month, I will get my bank interest, right? You want more simplicity, you don't want complex assets. This is the time when you start simplifying your assets also. If you are into equity, if you are into managed funds, etc., and your wife does not want to manage that complexity, this is the time when you also transition to index funds. So that you tell your wife, look, this can be a large cap index fund and a mid cap index fund, and that much is enough. You don't have to look for growth or value or things like that. You can simplify your portfolio. This is what you do. And then you say, okay, 35-40% we will be in equity. And going forward at 60, 70, 80, we will keep reducing our equity, because equity portion would have gone up. You will increase your debt and you will reduce your equity. This is the time when you start planning for your 60 to end of life.
But interestingly, you are saying that you can also treat it like a power play in a cricket match, in a one-day match or a T20 game. You are saying that that's when you can really become more aggressive, because you will have other means to support you. Even if you stop working in your mid-50s or late 50s, you will have enough money from gratuity and PF to support your living, and you can allow equity to compound extra for 4-5 years, by virtue of which you may, if you do it right, double your money one last time, after which your financial sustainability is a settled issue. So you are actually suggesting something which is in one sense unconventional, because most people are wired to thinking that I'll keep taking my risk up from 20 to 50 and I'll keep taking my risk down from 50 to 80. But the downside in that approach is that people end up with a lower corpus than they ought to. Maybe they miss 1 or 2 cycles of doubling, which means if your money should be 16 times, you only have 4 times. True. The difference is huge actually. Most people don't think about that. And your statement also actually didn't mention that, but that's the sense I'm getting. Instead of 50, if I'm going to slow my equity risk taking down at 62, it's quite likely that I can maybe play 2 more double cycles.
See, why I'm saying this is, even assuming you are at 80% in equity by the time you're 55, when your gratuity, PF and all come, all that will bring you down to 40% of equity, because these are huge chunks. If your PF has been untouched all your life and you have been earning well, that is going to be a big chunk. So all that is going to, you have to look at your asset allocation in total.
But there is a flip side to this. Not only the PF, in my opinion, even the EPF money should be taken out than going towards annuity, in my opinion.
No, the whole thing should not go into annuity. You should take out as much as you can.
So you will have enough money to run your life. That is the point I'm trying to say. So gratuity plus part of EPF plus PPF or whatever you're having. So it's a combination of all these things which will be available to you, and that can be used to run your life. And you can still take risk in equity for 1 or 2 cycles. That's the point that you're making.
Because see, what has happened is, by the time you're 55, your PF, PPF and all are huge amounts, right? And even 7% or 8% of that is going to be a big amount, and that for another 5 years. So you could actually double your PF from your age of 52, 53 till your age of 62 or 60, right? Because of the rate at which the interest is coming. I'm ignoring tax for a minute, but because of the interest rate, even if it is 7%, it is going to be a very good corpus. You're going to double it in say 10 years, and we are close to 8-9 years. So you're really going to double your corpus, and you're going to leave it untouched, and it is tax free. There can be anything better than that. I mean, there is some tax now, but at least your PPF is tax free.
So the clear thinking in your mind is use the 50s constructively. This works for a lot of people who have not done enough in the earlier years, and we have a huge majority of people who have underinvested or inadequately prepared for 50. So when they come to 50, it dawns on them that, hey, I don't have so much money that I can lead a great life after I'm 60. For such people, what you're saying represents some kind of hope that they could use their success in the 50s to reset their lifestyle for the retirement years. Because otherwise, they will have to downsize their life, they'll need to downgrade their lifestyle and live a much simpler life than they are living at 50 into retirement. So retirement life will be much simpler than life in the 50s.
No, Shyam, there is a bigger risk. If at 78 or 80 your corpus is zero or very close to zero, it means going back and living with your children. That is huge risk.
Even if you don't live with them, it is living depending on them, which itself a lot of people may not be able to take, because the personality of the Indian parent is like this. I have done everything that I need to do for you. I don't expect you to do anything for me. If I am not well, I expect you to physically be present. But even my expenses should be taken care of by what I have created. A sense of middle class pride dominates most people. The children have to convince them to take something from them. It's how it is. So that's what I have seen most people. Otherwise, if they take, then the parent equation tends to be a little bit weakened. Their hand goes down, which parents don't like. So for that purpose itself, they cannot go to their children and live with them, nor they can stay where they are and live with the support of the children. There is a issue here. Though my view on this is slightly different. I think that the amount of sacrifice a parent does for his child in the growing years and how much they do to ensure the child gets a good life in the future needs to be compensated adequately. In fact, I have a completely opposite view, but social view seems to be that there is a problem. He is now a different entity. He has his own family. I can't go and ask him for all these things. So that fear keeps people away from asking all these things. So effectively, if you want to be this type of personality, which is a type A personality, then you need to have enough money to keep you away from that predicament through life. Yes. Which means that you need to become aggressive at least at 50 if you have not been aggressive earlier. If you have been aggressive earlier also, continue your aggression for 10 or 12 more years. That's broadly what you are saying. What will be the ideal asset allocation?
Ideal asset allocation will depend on the understanding that person has about equity. Because if he has understanding of equity and he sees the equity market is going down when he is 52, he will stay invested till he is 62. He will not mind. But if the guy will panic at 55 and say, oh my God, the market is down, what will happen? What happens if the market remains down? And if he removes in panic, that would be the worst thing.
Mentally, he has to lock himself in.
He has to lock himself in till 62, saying, anyway, I'm going to get my PF and gratuity, which will pull me on till 70, 75. So by that time, market will recover. So the ability to sit tight has to be there. And also, annuity is pure debt. And I think a person should buy annuity in 3 stages. Once at 60 or 62. Once at 67, 68 and once at 74, 73, 74, because he'll get different pricing. So say 1 crore, 1 crore, 1 crore. Yeah, or whenever it's favorable, because he will get 3 types of pricing, and the third one which he buys, he'll get very good rates because he's buying it almost at the stage after the average age at which Indians die. So when he buys annuity at 74, he'll get an extremely good rate. So he should wait and buy his annuity in 3 parts. That is what he should do. And then again, the question is what numbers he and his spouse are comfortable. There is no point in having an extremely complicated portfolio which your spouse does not want to manage. If she wants to manage, it's great. If she does not want to manage, I see people, let's say 30 crore kind of net worth, build up with REITs and real estate and direct equity. Don't complicate. Your children and your wife may not want that complicated. So simplification of portfolio, yes, 20-30% in equity even when you're 75, 80 is needed.
But what about 50?
It's very difficult to say. At 50 you need to be at least 50-60% in equity.
That's the bare minimum.
Yeah, that's the bare minimum, because you've got a long runway. You could die at 100, so you don't know how long you're going to live, you don't know how long your wife is going to live.
Anyway, between 50 and 60, your debt corpus is going to double. Whatever you kept in PF, PPF and it's going to double in that decade.
Yeah, you have to build for that. So therefore, even if you're at 60-70%, you know at 60 you'll move to 40%.
So at 50 you can go overweight equity because you know your debt will again come back at 60.
You should go overweight equity. Absolutely. Absolutely.
That's your lever.
In fact, I'm even saying after 60, if you are say 60% or 65% in equity, your monthly withdrawals, you do it from equity. That you can do. You can always withdraw from your equity.
What type of, you mentioned asset types, you said don't go to REIT and all these complicated products, which means AIF also in the 50s is not a great idea. Do you advocate putting all your money in asset classes where you can get the money out in day or two?
See, it's every portfolio.
All financial assets, right?
Yeah, all your financial assets should definitely have safety, because you don't have any ability to lose money now. Then you always have to make a compromise between liquidity and risk, and liquidity and risk. So if all your money is in your savings bank account, that is ideal in terms of liquidity, pathetic in terms of returns. So some compromise, I mean, when you have money in PPF, you know it's locked in for 15 years. Similarly, when you have money in equity, you should think it is locked in for 10-15 years. So if the market is down, you should not remove, but when the market is up, good time to remove. Should all your assets be fully liquid? It's a very, I mean, unnecessary kind of a situation, because your annuity and all which you buy is anyway gone out of your hand for the rest of your life. You will not get back the corpus. So that is gone. So some liquidity you should have, maybe 15-20 lakhs, 25 lakhs liquidity. You have medical insurance, you may still continue to have a credit card with 10 lakhs of that much liquidity. I think in every portfolio, liquidity is overplayed, the role of liquidity is overplayed, and the role of return is underplayed. So you have to have a judicious mix. You have to see how much, realistically how much you need, because medical emergency at that age might mean 10 lakhs. You don't need to have 50 lakhs of liquidity.
Effectively, your asset allocation should have a house which is fully paid off. You have debt which is anyway going to come to you only at 60. You are not going to use the debt in the interim. So you are having long-term debt at 50, in the 50s. Your equity should be allowed to run for at least a decade. And by virtue of that, you try to grow your overall corpus significantly. You are talking about 50-60% of allocation. Gold and jewelry, you have to the extent it's required for your security, or you convert what you already have into something which is in a more simpler form to convey to the next generation. Succession should not be a problem in that. Safety should not be an issue. What about people who want to speculate in the 50s? We have talked about all these safe things. Should somebody speculate a little bit? Should I have 5-10% of my capital for speculation in the 50s, so that I kind of, if I'm lucky, I make some money, otherwise I just leave that money aside? Is it something worth it doing?
Depends if you've done it at all, because if it's your relationship manager who is doing it with you, the chances are he will tempt you to do more and more, like what happened to Yudhishthir. You don't know how much you're losing, when you will stop. You might have lost 7-8 lakhs, 10 lakhs, and then you will not tell your wife. You will remove some money from the family portfolio, you will use it, you will be tempted to do it, and your relationship manager who is interested in more velocity in your portfolio will make you do it. It's a very scary situation. How many people can say, I have tremendous discipline, if I lose 10 lakhs, I'll stop?
They lie to everybody actually. Lie to friends, lie to auditor, lie to wife, lie to everybody.
They destroy families. So I wouldn't advise. Speculation for fun is like playing a video game today. Maybe, but only with husband and wife both doing, both sitting and having control. I don't see too many couples like that, so I wouldn't advise.
And now I'm going to take you up on the point of velocity. Decision making velocity in the 50s, how should it be? Because that impacts asset allocation. Because all impulsive decisions generally distort asset allocation. So how should the velocity of decision making be? How much, what pace? How should I view it? Should I listen to whatever people say and immediately act? Or should I just have a playbook and I not deviate from it? Or should I keep an advisor and just simply go by what he says? Or should I just give my money to a manager and just be happy with what he is doing? Most people are confused what works best for them. Any clarity you would like to throw on that?
First of all, I don't find any equity advisor. There is no equity advisor on whom you can sound out and who will deal with you, because there is no way how you can compensate that person. Either he does it free for you because he is in love with you, he is a friend, or he is a relationship manager, then he is interested in trading. Relationship manager is a wealth manager for the bank, not for you. So he is not the best person, and he will have 3 years experience. In your 50s you may have 25 years experience or 30 years experience. This guy has 3 years experience. He does not even understand you. he makes money on the velocity, and wealth creation happens with zero velocity.
Okay. Static.
Static portfolio. I mean, if the country is going to grow at 9%, just sitting tight on an index also you will make money. Why do you need velocity? You don't need velocity. So, no.
So, low to no velocity is how you have to do it. Just keep putting money into a set pattern of investments which you have faith in. Keep reviewing whether that pattern is working. If you need to tweak the pattern, take a judicious call and don't do it for the sake of doing it. And get your asset allocation fine-tuned constantly so that you are able to participate where you need to, and you are able to also improve asset allocation as you move further in the 50s. Is that right?
Only thing is some asset like a house, you may have to reconstruct. Need to provide for that, at least the construction cost, because you sell your old house and buy a new house. Like if you bought your house when you were 40, maybe at 70 you need to rebuild that house. So need to provide for those things. Other than that, your washing machine and fridge are not going to bother you. But one big asset, house replacement could be a big thing. Need to provide for that. You could do a deal with your son or your daughter saying, I'm buying this house, I'll give it to you. We can do internal reverse mortgage, something like that. But that is one cash flow which might be big. Other than that, you don't have to worry.
It's been very interesting discussing the 50s because we have come up with some views which are, in my view, out of the box in this discussion relating to velocity of investing, whether you need to use the 50s as a power play to improve your returns, and how you should look to touch your debt corpus earlier if you need to be living off your retirement corpus earlier than you planned. So touch your debt corpus first, allow your equity to compound for one more cycle, which is a very, very fascinating point, because if all you need to do is execute that well and the results will be there.
No, and Shyam, is the most important cycle because your corpus is at its highest when you're 55. So 55 to 62, if you can double your...
So one extra cycle means it's different. But a lot of people think in their mind that if they are not done enough by 50, they can't do too much by the time they retire. What you have discussed today in this video actually gives hope to those who have not done enough, and they should probably take the right help and make sure that they catch up with their retirement corpus and wealth corpus just the way they have caught up in their careers in the 40s to come to where they are in the 50s. You are in a better place career wise, so make sure that you get to a better place wealth wise, and for that asset allocation in the 50s is the critical success factor. That's the summary of what we have discussed. Thank you very much for this wonderful discussion, Subra.